This next QE cycle will crush Gen Z. Quantitative tightening just ended on the 1st of this month, and now everyone in America is eyeballing quantitative easing going into 2026. Quantitative easing is a form of monetary policy where central banks flood the market with money and buy long-term securities in an effort to stimulate the economy. And while changing monetary policies is part of any healthy economy, and quantitative easing in and of itself isn't the worst thing in the world, they're usually done to spur economic growth in a slowing economy. And Clear Value Tax actually just made a great video and he talked about why this isn't the case. So during quantitative tightening, the Fed shrinks its balance sheet and reserves drop. And he explains if reserves drop too far, then the repo rate will spike up. And if the repo rate spikes up too far, the money markets are going to break. That's what he said verbatim. And basically, we're trying to avoid that. Now, that all sounds well and good, but you got to remember why people use quantitative easing in the first place. And this isn't exactly the best time for us to start doing that right now. While yes, non-farm payroll has been declining since February of last year, and the unemployment rate has been ever so slightly ticking up since January of last year, we're still in a decent spot. And if we think about past quantitative easing cycles, those were implemented in heavy economic contractions and low asset prices like COVID and the 2008 crash. Right now, asset valuations are pretty high, and relative to those events, we're in a pretty good spot as far as the economy goes. And if we want to get a little more specific, let's think about interest rates during both of those times. During both of those events, interest rates dropped to damn near zero, and that's when you want to use quantitative easing, when cutting interest rates just isn't enough. Not only have we not seen that yet, but our interest rate right now is more than double what it was in January of 2020. This is just not the time to start a new QE cycle, and that's not even mentioning rate cuts or the new Fed chair. Let's talk about that. Interest rates are literally the rate at which you borrow the dollar. Rising interest rates cause the dollar to be stronger because you have to spend more to borrow it, which in turn means it's worth more. And the opposite is also true. Lowering interest rates makes the dollar weaker because it's quite literally worth less. Now, this might sound crazy. Why would you ever lower interest rates? But typically, you would do that to help spur economic growth. There's always pros and cons with these. Now, while the cuts themselves might not have been that big, we've already had 2 interest rate cuts this year, and there's an 86% chance of another one on December 10th. Now, there's always the chance that this doesn't happen, but Jerome Powell always likes to go with what everyone thinks will happen because he doesn't really want to cause a big market shakeup. So we're printing more money with QE. That devalues the dollar. We're lowering interest rates. That devalues the dollar. But what about the new Fed chair? Couldn't they just reverse this position? It's actually kind of the opposite. So Jerome Powell, our current Fed chair, has his term ending in May 2026, and we're going to need to appoint a new one. And while the president doesn't have 100% supreme overarching authority, they do play a very big role in who gets picked. What this means is that Trump is most likely going to pick someone who shares a lot of the same views as him, and most of the public seems to agree it's probably going to be Kevin Hassett, who is historically dovish. This is just a fancy way of saying him and Trump both like lower interest rates. So all of these things combined are honestly really scary, and that's not even mentioning all the recession indicators and just all the doom and gloom stuff everyone on the internet has been talking about recently. But I like to be optimistic. So what is the one shared outcome across all of these decisions? It's that asset prices will rise. So if you couldn't already tell, what do we do to combat this? You have to get invested. Maybe you already invest more. If you don't invest at all, you really need to start, I beg you. But with all this crazy stuff going on in the markets, what is the most optimal way to invest? Well, I know this goes against like everything that I've been saying these past few months, but you have to get diversified. And I don't mean buy 100 different stocks or buy the S&P 500 or the total market index, although those are phenomenal options for 90% of the world, and I recommend that to like everybody, but that's not exactly how I prefer to invest. But what I specifically mean is diversify across different asset classes. Yes, the stock market will rise, but assets as a whole will rise, and you don't know what'll rise the fastest. There are decades where some asset performs way better than another. I know REITs were killing it until pretty much these past few years. But if you only own stocks, maybe buy some REITs or some real estate. Maybe you own real estate. Put money into crypto. I just made a video talking about Bitcoin a little bit. Buy some precious metals like gold and or silver. Gold has been doing really well recently, and it's considered a safe haven. Pretty much every time the dollar dips, people throw their money into gold because it retains its value. I've also been seeing a bunch of crazy stuff about how the yen is crashing. And if you have the US dollar crashing as well, these are both major safe haven currencies. But if they're both losing a lot of value, it might be time to look somewhere else like gold or Bitcoin. They're both looked at as stores of wealth, and a lot of people will flock to them during hard times. Now, look, there's no one size fits all for this, and I can't tell you what you need to do. Everyone's situation is different. But I can tell you what I'm going to do. I'm a dividend growth investor at heart, and most of my money is in stocks. I don't own any gold, whether that's physical or ETF. I wish I did, but I don't exactly make enough money to be able to spread my money across everything that I want every paycheck. But I do plan on owning some gold in the future. With that being said, I don't have all my money in stocks. I did recently just start building up a small high yield dividend portfolio, and within that, I own a couple REITs. Now, REITs only make up a little over 5% of my total portfolio, but I have been buying a couple of shares of Vici properties every time I get paid, so that's slowly going up. Aside from that, I have actually started putting some money into crypto. I know I've sounded a lot like a crypto bro recently, and it's crazy to think because I'm still pretty weary of it. But I have a little over $300 split between Bitcoin and XRP. I know it's not a ton of money. I don't plan on having it as a huge chunk of my portfolio, but again, I am slowly adding to this every time I get paid. I do prefer more of a concentrated approach to investing, but I also think it's a good idea to be spread out across a couple different asset classes, and I think I'm doing a decent job of it so far. But let me know what asset classes y'all have money in, or maybe even how much of your portfolio you plan on allocating to a certain asset. That's basically what I have to say for this video for now, but I got to pad the video a little bit, and I didn't really know where to throw some of this stuff in, and I also didn't want to make a video just to say invest into stocks. But let's talk about the economy. So I've been saying this whole video, there's all these recession indicators and stuff like that, and I have this really cool software that I got when I was really into trading. So I just wanted to show you all some of these metrics. Now, the main thing that I wanted to show was this inversion chart. This goes back to 1990, and it shows the 10-month bond yield versus the 3-month. And all you really need to know is that when it goes below this red line, that's called inversion, although that in and of itself isn't a terrible thing. It's when it comes back. So every single time that has happened since World War II, it has been followed by a recession between 6 and 18 months later, and a lot of people look at this as a leading indicator. Now, maybe you don't think the whole tariff crash was an actual recession. I know I've heard people say we've been in a rolling recession for years, but regardless, that happened. But what I noticed when looking back at this chart again is we had another inversion cycle happen on February 24th of this year. I was also watching a Financial Freedom 101 video earlier, and he talked about how the consumer confidence index is below 80, which is also a sign of a recession ahead. But I really just wanted to show the inversion chart because I assign a lot of value to that. So what am I going to do with this? Well, I think pretty much if you do the math on every recession ever, if you invested through the recession, you came out ahead versus all the people who didn't, like every single time. So I'm going to continue to invest, but I'm just going to take a little bit of money each paycheck and put it aside. So whenever that crash does happen, I'll have some type of little sum that I can throw in. But there's all types of stuff I can look at, like historical institutional positioning. So here's a screenshot of the historical COT data of the dollar going back to the first of last year. And as you can see, on March 21st of this year, institutions started really dumping the dollar. I think that's a sign that it might not be a good idea to hold a lot of cash. And as a little thank you for watching this video, I'll show you some metrics on the S&P 500 and Bitcoin. First of all, it's never a bad time to buy the S&P. With that being said, it might be a bad time to buy the S&P. And what I mean by that is 90% of retail traders are buying right now, and the put to call ratio is showing extreme greed. And what this means is we're probably at a top. Now, this doesn't mean we're going to have a market crash right now, but we could see a little bit of a pullback, even if it's a very, very minor one. But in a similar vein, if we take a look at Bitcoin's put to call ratio, it's showing extreme fear. And this is basically the opposite. It might be a pretty good time to buy Bitcoin. Keep in mind, none of this is financial advice and Bitcoin is extremely volatile. But in case y'all were wanting to invest, I just wanted to give y'all that information. But anyways, I hope you got something out of this video. If you did, consider leaving a comment, consider subscribing. I would really appreciate it. Good luck on your investing journey.